Okay. So we have done IFRS 16, that is leases. Okay. We have done IFRS 9, that is financial instruments. That is financial instruments. Okay. We have done 36, that is impairment. Okay. We have done 36, that is impairment. Okay, we are going to do the IFRS 5 today. That is non-current asset held for sale. And what I want us to do again is maybe we just look at the major standards. So maybe next one we are going to do earnings per share. So maybe next one we are going to do the 33, which is earnings per share. Then after the earnings per share, maybe we look at 38. After the 38, maybe we look at 16, or maybe we look at 37. Okay, I'm sure. Okay, these are the major standards that maybe if you go to the exam, maybe we can add 12. Okay, I have a video on 12 already, but we can add 12. So, or 15 will take our time, but we can add a 15. By 10th February, we should be able to finish. So maybe 5 today, 33, 38, 16, 37, 12. Let me check. Mm. Okay, so today we are going to look at the brother of the 36, which is the non-current asset held for sale and discontinued operation. Okay, you see, we all know that a company may purchase a non-current asset, which we used to call a fixed asset. A company may purchase non-current asset for three main reasons. Okay, they may purchase or they may acquire a non-current asset for three main reasons. One of them is for administrative use. For administrative use. One of them will be for administrative use, which we call the owner occupied. Okay, so they want to, maybe they can purchase equipment that they will be using in the office. Okay, or they can purchase land that they are going to build on it. So the company will be using the asset themselves. In that case, if the asset is being purchased purposely to help the company run its operations, to help in the what? In the running of the company, in the day-to-day running of the company, that particular asset will be classified under 16, IS 16, which is property, plant, and equipment. So a company may purchase a non-current asset that will be used for administrative purposes, or that will be used in producing their commodities or their goods. They are going to use it as a cash generating asset, something that is going to help the company to run well. So it can be for administrative purposes, which can be like computer. It can be for delivery van, which they can be using to what? To deliver their goods to whatever they want to deliver the goods to. Okay, if that is the case, that particular non-current asset will be classified as what? PPE, which will be accounted for with the principles of what? The IS 16, property, plant, and equipment. Okay, a company may also purchase a non-current asset, for resale, to be for the purpose of resale. So they will purchase it and resell it to people. In that case, that particular asset will be classified as inventory, which will be accounted for under the provisions of what? The IS2. So a company can be buying a computer, those who are into selling of computers. So they will buy the computer and sell it. In that case, the computer becomes what? An inventory to them. computer might be a non-current asset or a fixed asset to someone, but the same computer might be what? A current asset, which will be an inventory to, to another person. So the company may purchase a non-current asset, which will be purposely for resale. In that case, it will no longer be non-current asset, but it will be a current asset, which will be classified as inventory. So they will use the IS to account for that particular what? Asset. Okay. A company may also purchase a non-current asset for rentals, or might be for rentals, or they want to keep it so that the value increase in the future, then they will sell it. So that particular one will be classified as investment property. So we can purchase a car, which will be the aboboya, then we'll be what? We'll be renting it to people. We'll be using it for rentals. So that particular one, it will be under investment property. Okay, so the initial recognition is that the asset might either be classified as investment property, inventory, or a PPE. Okay, what will happen afterwards? What will happen afterwards? Okay, the company can purchase a vehicle. The company can purchase a vehicle. Okay, the company can purchase a vehicle. They will use it for 2 years. Then after the 2 years, a new model of the vehicle will come, or they will manufacture a new model and the company want to purchase the new model. What would they do? They have to what? They have to sell the old one, or the company doesn't need what? The motor vehicle again, or the motor vehicle is now surplus to requirements. It's just there idle. So what do? We need money. What do? We have to sell it. We have to sell it. So the non-current asset held for sale, which is IFRS 5, is the IFRS 5 comes in when a company has now decided not to what? Use the motor vehicle for administrative work again. They don't want to use it for rentals again, and they now want to sell it. They don't need it again, so they want to sell it. If they want to sell it, then they have to classify that particular asset as what? Held for sale. So the held for sale comes in when the company has now made a decision that we are no longer going to use this particular asset for administrative purposes, but we want to sell it. We want to sell it. So if you want to sell it, that is why the non-current asset held for sale comes in. So if the company made a decision to sell the asset, then they have to classify the asset as held for sale in their books. So the standard says that a non-current asset, the standard says that a non-current asset can only be held for sale, can only be classified. So the standard says that assets can be classified as held for sale. Held for sale can be classified as held for sale. Held for sale if and only if and only if its carrying value will be recovered through a sale. So you can only classify an asset as held for sale if the carrying value of the asset can only be realized through what? Through selling it. So if you made a decision to sell the asset, then we can say that, okay, that particular asset may be qualified as held for sale. But you can't just stand up and say, okay, you have made a decision to sell the asset, so you are going to classify the asset as held for sale. How soon or how probable is the sale? The asset is what? Is at the workshop, it's under maybe repairs or maintenance, and you are saying that you are going to sell the asset. The asset is not in a good condition. You had an accident with the car, the company or the driver had an accident with the car. The car is at the shop, and you are now saying that you are going to what? Sell the car. No, they are doing work on the car. Is the car in a condition that it can be available for immediate sale? If no, then you can't classify the asset as held for sale. So although you may decide that, okay, I want to sell this asset, the only way I can get a value from asset is selling it. I will not continue using the asset and I will not even put it there without using it. So I want to sell the asset. So if you want to sell the asset, then that particular asset might be classified as held for sale if you are able to meet certain conditions. So after making the decision to sell the asset, you now ask yourself, how soon is the sale? Or is the asset ready for sale? Is the asset in a condition that I can sell it? Have I undertaken any plan to get a committed buyer for the asset? Okay, if I want to sell the asset, have I gotten an agent to get a buyer for me? Were there any plans to get a buyer for the asset? The asset is 10,000. Am I advertising the asset at its current market value? The asset in the market, the asset is 10,000. And you are now saying that you are going to sell it 50,000. It is clear that you don't want to sell the asset. So after the decision has made that we want to sell the assets, you have to meet certain conditions that before you can classify the asset as held for sale. So let's look at the conditions. So the conditions that might be met before you can classify the asset as held for sale. So what are those conditions? Okay, so the first one is the the sale might be probable. Okay. Okay, let me just, I don't want to read my mind, so let me just bring up a slide so that we just pick it there. See, sometimes I just wake up. If I want to crack my brain, it will worry me. Have to be met. So these are the conditions have to be met before the asset can be classified as held for sale. So I just wake up. I can't be worrying my brain like that. I haven't eaten. Okay. So the first one is that the sale is highly what? Probable. The sale is highly what? Probable. We are convinced that we are going to sell the assets. We are convinced that we are going to sell the asset. There is nothing that we are going to do than selling the asset. So the sale is highly what? Probable. Okay. The item is available for immediate sale in its present condition. I've said this. The asset should not be at what? At a mechanic shop. And you are saying that you are advertising an asset that is not ready for sale. Asset that is going to take like 2 years before they will finish doing what? The body works on the asset. The asset, the engine is wearing the asset. Now you are advertising the asset for sale. If you get a buyer, how do you go about the engine? So the asset must be in a condition that it can be available for immediate sale. So everything is working, everything is perfect. The asset should not be at a workshop. The asset should be, you see some people, they'll write for sale on the assets and still be using the asset. No, that is for individuals. For companies, as soon as you say that you are going to sell this asset, the asset has been classified and held for sale, you are not going to be using the asset again. You are not going to be using the asset again. So that's the item is available for immediate sale in its present what condition. An active program to allocate a buyer has been what initiated. You have gotten what you say you want a room to rent. You are in the house. You are just telling us that you want a room to rent. How you say you want a room to rent? You are just in the house. You are not serious about getting the room. If you want the room to get, you have to start looking for agents. Yes. So if you want to sell the asset, you have to start looking for buyers. By what? Looking for agents to get a buyer for you. That would tell us that you really want to sell the assets. You see, we don't want a situation where people will, like, they want to do what we call profit smooching. So they want to apply that creative accounting mindset where, okay, they want the profits this year to look good. So if they want a profit this year to look good, it means that they want to classify the asset as held for sale so that they will not charge depreciation on the assets. Then the depreciation is not going to reduce the profit and the profit will look good. Then the following year, then they will say that they are not going to sell the asset again. Then they will reclassify the assets. So they will make decision, they will make profit to be bigger in 1 year and profit to be lower in the other year. It's a form of creative accounting which accountants will do. So they are saying that even if the company has made a decision to sell the assets, certain conditions must be met before the asset can be classified held for sale. We have to see the sale to be probable. We have to see the sale to be probable. We have to see that, okay, the entity is committed to sell the asset. You can't say that you want to sell the asset and you are still using the asset. What shows that you want to sell it? So everything has to show that you really want to sell the asset. That is the only time that you can classify the asset as held for sale. All right. So these are the conditions. These conditions are preventing what accountant not to what apply what we call a creative accounting mindset, where they will classify the assets, they will not charge depreciation, make the profit to look good this year. Then the next year they will say that, okay, we don't want to sell again. Then they will reclassify the assets, and then they will charge depreciation, and the what profit will be looking bad. No, that is not what we want people to do over here. Or they realize that no, their liquidity position is not okay. Then they want to classify the asset ahead for so that it will increase their current assets so that their liquidity will look good. Or their liquidity position or their liquidity ratio will look good. No, they want to prevent that. They want to they want the accountant not to do that or not to deceive the public, especially the users of the the financial information. So that is why they are putting up this criteria over there so that even if you have made a decision to sell the asset should be in the condition that you can sell it. We should see it through your behavior that you really want to sell the asset. You say you want to sell your phone. You say you want to sell your phone. If we ask you how much are you selling the phone, you are not mentioning the price. It means that you don't want to sell the phone. You are just deceiving us. All right. So an active program to locate a buyer has been initiated. So we started talking to agents to get a buyer for us. Or we started advertising in the national newspaper that we want to sell this particular asset. So we started a program that to show that okay, we are looking for an active buyer or we are looking for a buyer for the asset. That will also show that we really want to sell the assets. All right. So the sale should be expected to be completed within a year from the date of what classification. So if you want to classify the asset as held for sale, the first thing is, can you be able to sell the asset within a 1 year or within 12 months? Can you be able to sell the asset? If yes, then fine. All right. Management is committed to a plan to sell the item. So we are not going back on our ways. We are going to sell the asset. No going back. Is the sell is the sell. Management is trying everything possible to sell the assets. And maybe since they want to sell that particular asset, they have acquired a replacement for that particular asset. That is also showing that management is committed to the plan to sell the assets. The asset that you want to sell, the asset should be what? Marketed at a reasonable price in relation to its current market value. All right. You can't say that you are selling iPhone 7. You are selling iPhone 7. Then you'll be mentioning 5,000 for iPhone 7. Are you serious? No. It means that you don't want to sell. You are just saying it that you want to sell. You are scaring people. If you really want to sell the asset, you have to give a reasonable price for the asset based on the market price. If you really want to sell your, I don't know, the delivery van, maybe the company is having a typewriter, they want to sell it, and you are now telling people that they should buy the typewriter 2,000 Ghana cedis. Even laptop that they can use as a replacement for the typewriter. Some people can get a nice laptop at what 2,000. You are saying that they should buy the laptop, they should buy the typewriter at 2,000. No, it is clearly showing that you don't want to sell the assets. So if you want to sell the asset must be marketed at a what? At a current market price, at a reasonable price. You say you are selling pen and you are saying that the pen is 100 cedis. Which type of pen is that? Is it a pen that if you write it, you go to heaven direct? No. So if you want to sell the asset should be what? Marketed at a reasonable price. Something to show that, okay, this price is a fair market price, means that you want to sell the asset. All right. After the decision has made that you want to sell the asset, after the decision has been made that you want to sell the asset and all criteria for the classification has been met, the first thing that you have to do is that you ask yourself, okay, you ask yourself, which of the models that are you using for the asset? You see that we have the cost model, okay? You ask yourself, what are the models that you are using for the assets? So how are you accounting for the assets? Okay, You can be using the cost model, or you can be using the revaluation model or the fair value model. Okay, so you can be fair value model or revaluation model. Okay, so you ask yourself, which of the models am I using for the assets? It can be investment property, it can be a PP that you want to sell. So if it is investment property, you will be using the cost model or the fair value model. Okay, if it is PP, you'll be using the cost model or the revaluation model. So you ask yourself which of the models that you are using to account for the what? The assets. All right. Before I'll move on to the models. You see, when you enter into an agreement to sell and lease back an asset, you can't classify the asset as what? As held for sale. Because the agreement was what? You want to sell the asset and lease back. So the asset will be carried at the carrying value. Okay. So sell and lease back is not part of the head for sale. As soon as you have entered into agreement with someone to sell the asset and lease it back, then the assets have to be what? Given to the person at the carrying value or the fair value. All right. So sell and lease back is not part of the what? The head for sale. You can see a question where they see the company has entered into agreement to sell and lease the asset back immediately. So the company is planning to what? Classify the asset ahead for sale. No. You see, if you are looking at sell and lease back, the right of use is being calculated on the carrying value. The carrying value is the what? Is the historical cost minus what? Or accumulated depreciation or accumulated impairment. So if you are classifying the asset ahead for sale, it must mean that you are going to classify the asset at the lower of the core, at the lower of the net realizable value or the carrying value. So sell and lease back is not part of this particular classification. All right. So since you have entered into a contract to sell and lease back the asset, it's out of what? The head for sale. The head for sale means you are going to sell the asset and transfer ownership and everything to the person. You are not going to be retaining part of the ownership. No. All right. You can also not use an asset as what? As a collateral security for loan and be saying that you are going to what? Classify the asset as head for sale. If you want to classify the asset as held for sale, it means that ownership, risks, everything associated with the asset will be transferred to what? To the buyer at the end of the transaction. All right. So after that one, having said that, let's come to the models. So after the decision has made that we are going to sell the assets and all criteria for what? For the classification has been met, the first thing is you ask yourself, the asset that I'm going to sell, is it carried under cost model or revaluation model? If the asset is carried under the cost model, then at the date of classification, 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 then you have to test at the date of classification in impairment test. Impairment test should be conducted on the assets. Okay, impairment test should be conducted on the assets. Should be conducted on the assets. Okay. Why are we saying that impairment test should be conducted on the assets? Okay, they will be giving you the, okay, you can determine the carrying value yourself, but the question will be giving you the net realizable value. How do we calculate the net realizable value? Is the fair value minus the cost to sell. Okay, so they will give you the fair value and the cost to sell. You determine it. Okay, then you also determine the carrying value. Since the asset is carried under the cost model, we can't fair value the assets. So what we have to do is that the net realizable value over here is technically the recoverable amount. Okay, because we are not going to continue using the asset. We can't determine the value in use because we want to sell the asset. We just want to sell the asset. So the net realizable value becomes the recoverable amount. So at the date of the classification, we ask ourselves, what is the recoverable amount of the asset and what is the carrying value of the asset? Is the carrying value higher than the recoverable amount? If that is the case, then the asset has impaired. Then we bring the value to the recoverable amount. Okay. If at the date of the classification, the recoverable amount is higher than the carrying value, it means that the asset has not impaired. So the asset should be carried at what? At the carrying value. Okay. So the lower of the cost, the lower of the carrying value and its net realizable value is just for the idea of what? The impairment test. For the idea of the impairment test. So if the asset is carried under the cost model, at the date of classification, the asset should be classified at the lower of the carrying value and its net realizable value. Why are they saying this? If the carrying value is 5,000 and the net realizable value is 6,000, the asset will be classified at 5,000. What does it mean? It means that the asset has not impaired. The carrying value is lower than the recoverable amount, which is technically the net realizable value. So if the asset is carried under the cost model, we are just looking for either the asset has impaired at the date of classification or not. If the carrying value is lower than the recoverable amount, then we classify the asset at 5,000. And that is why they are saying that it should be the lower of the carrying value or the net realizable value. Okay. If the carrying value is 5,000, the net realizable value is 4,000, it means that the recoverable amount is what? Is 4,000. And the carrying value is what? Is 5,000. The asset has impaired by 1,000. So we bring the asset to what? To the 4,000. So the lower of the carrying value and the its net realizable value, they are just telling you that at the date of the classification, carry out an impairment test on the asset. If there is an impairment test and the asset does not impair, then it should be carried at the carrying value. If the asset impairs, then it should be carried at what? The recoverable amount, which is technically the net realizable value. That's what they're just trying to tell you. What you have to know is that we assume that asset that is being classified as held for sale, the company will not be using it again. So since you are going to sell the car, it's not that you write for sale on the car and be riding that and be driving the car again. No, that is for individuals. Standards are not for individuals. Standards are for companies. So as soon as you say you are going to sell this particular asset, it should be there. You don't have to be using it. So asset classified as held for sale, we don't depreciate them. Even if the company is using them, we don't depreciate them. So assets classified as held for sale are not depreciated. Take note of that. They are not depreciated. We don't depreciate them. At the date of classification, since we classify the asset as held for sale, we don't depreciate them. Okay. So if it is under the cost model, it should be the lower of cost or the net realizable value, which is technically they are asking you to carry out an impairment test on the assets. Okay. If the asset is carried under the revaluation model, the case will be different. Okay. If it is carried under the revaluation model, the case will be different. Okay. If the asset is carried under the revaluation model, the case will be different. How will it be different? It will just be the same as we are applying our revaluation model. At the end of every year, we revalue the asset. That is all. So the question can give you the carrying value of 5,000 and it will give you a net realizable value of 7,000. A net realizable value of 7,000. What are you going to do? The asset will be classified as 7,000. So the lower of that cost and the net realizable value does not apply to an asset carry under revaluation model. No. It does not apply to asset carry under what? Revaluation model. You see, most of the standards are being developed for the default method, which is the cost model. If you look at most of the standards, they are being developed for the default model, which is the cost model. If you look at impairment like this, most of the things are talking about what? Cost model. If you look at leases, the right of use is talking about what? Cost model. So if you are using revaluation model, the lower of cost and its next realizable value does not apply here. It does not apply here. So what we do is that our next realizable value is 7,000. Our carrying value is what? Is 5,000. So there will be a revaluation surplus of what? Of 2,000. So we recognize the revaluation surplus, and we classify the asset at what? 7,000. We classify the asset as 7,000. Or they can give you a carrying value of 5,000. Then they will give you a fair value of 7,500. Then they will give you cost to sell. The cost to sell of 500. Okay, you have two ways of doing this. First of all, you can revalue the asset before the classification. So you revalue the asset, then you are going to be having 7,500 minus 5,000. You are going to be having a revaluation surplus of 2,500. Then you will now come and classify the assets. If you classify right now, your net realizable value will now be 7,000. So your carrying value of the assets now will be 7,500. Then your net realizable value will now be 7,000. Okay, so you can see that the carrying value of the asset is 7,500. They are saying that the net realizable value is 7,000. It means that this particular asset has impaired by 500. But this 500 will go to other comprehensive income because there was a previous revaluation gain on this particular asset. Another way of going about this one is you just have your revaluation surplus, then you just calculate your net realizable value straightforward minus the carrying value, which will be the 7,500 minus 500. That will give you 7,000 minus 5,000, and that will give you 2,000. So you classify the asset at 7,000 straightforward, and you are going to have a revaluation gain of what? 2,000. It's the same thing that you are going to do over here. This will cancel this, and you have 2,000. So if you have the asset classified under the revaluation model, the lower of course and those things that will not apply here. Yes, you have to first revalue the asset before you classify. You first revalue the asset before you classify it. So basically, this is about this one. So this is the initial classification. Before you actually sell the assets, there might be a subsequent measurement. So the subsequent measurement, you subsequently what? Measure the assets. So let's assume that our first classification, let's assume that we are using cost model. So we are going to be having a carrying value of 5,000 and a net realizable value of 4,000. Okay. There will be an impairment loss of what? How much? There will be an impairment loss of how much? Carrying value is 5,000. Net realizable value is 4,000. There will be impairment of what?
1,000.
Okay.
1,000.
So there will be impairment.
1,000 cedis.
There will be impairment of what? 5,000 minus 4,000. Okay. So that will be 1,000. So the asset will be classified at how much? At what value are we going to classify the assets?
4,000.
Okay, that will be the recoverable amount.
4,000.
Okay. So the asset will be classified at 4,000 initially. Okay. Assuming that before we are going to actually sell the assets, we now realize that now the net realizable value of the assets now is 5,500. So maybe the classification after 6 months, the the net realizable value of the asset is now 5,500. Okay, the net realizable value of the asset is now 5,500. But what was the carrying value at the date of the classification?
4,000.
5,000. It was 5,000, isn't it?
5,000.
Okay. Now they are saying that the next valuable value was what? Is now 5,500. So has the asset impaired in the first place? It was 5,000. Now they are telling us that it is 5,500. Is there any impairment on the asset in actual sense?
No, sir.
No.
There is no impairment. So this will now be 5,000 against 5,500. So the asset should have been classified at what? At 5,000. But we are having 4,000. So what we do is that we reverse the impairment because there should not be any impairment in the first place. All right. I will take this one again. If there is a subsequent measurement on the asset, okay, there may be that there can be additional impairment again, which will be recognized to profit or loss. There can be that the value of the asset will now increase. If the value of the asset increases, since we are carrying the asset under cost model, we only reverse the what? The previous impairment loss up to the extent of what? The first impairment loss. So you can't say that the value of the asset is now 4,000 and it is now 5,500. So there will be a gain of what? 1,005. No, you have only recognized an impairment loss of 1,000. So you can only recognize 1,000 of this one, not all the 1,500. So if there's a subsequent measurement and that results in a gain, the gain can only be recognized up to the extent of the what? The previous impairment or the previous loss recognized on the assets. Or you first ask yourself, what should have been the carrying value and what is the next valuable value now? Has the asset impaired in the first place? If yes, by how much? Okay, so it can happen that the next valuable value given to us will now be 4,500, but we classify the asset as what? 4,000. Okay, we classify the asset at 4,000. Okay, you have to ask yourself, if impairment was not done on the asset or impairment was not recognized on the asset, the carrying value of the asset should have been what? Should have been 4,000. The carrying value of the asset, the carrying value of the asset should have been 4,000, should have been 5,000 against 4,500. It means that the asset has impaired but only 500, but we have recognized what? 1,000. So we have to go and reverse what? 500 back. This can also be done as comparing your 4,000 to 4,500. This has increased by 500. You recognize all the 500 because the impairment loss was what? Was 1,000. Was 1,000. So if there's a subsequent measurement and there is an impairment, you have to recognize the impairment again. There can be a subsequent measurement where the next valuable value will now be 3,500 and your carrying value will be 4,000. You see that there is still an impairment loss of 500. This should recognize or this should be recognized in the profit or loss account. Okay, so you have to remeasure the asset before the actual sale, before the what? The actual sale. So I'm sure this is all I can say about this one before we pick one question, then we go back and come. All right. So let's pick one, or let's pick two questions. Okay, let's pick two questions, then we see how we can go about this. Okay. Okay, the question one. Okay, can we pick question four? Question four and question 4 and 7. Okay, let's pick 4 and 7. 4 and 7. Yeah, the one day you can try. See, some of the questions are not for me. They are questions that if I'm solving them, I'll feel like I'm doing nothing. Okay. So the one there is question that you have to try to see that okay, you actually understood what was said in the class. All right. So let's take the 4 and 7. Who is reading for us? Please, who is going to read for us?
Okay, I'll be reading. Question 4. Nkonya is a local food processing company whose accounting year is December 2021. And please, can you hear me?
Yeah, we can hear you.
Okay. And prepares its financial statements using IFRS. On 1st April 2021, Nkonya moved to a new head office and decided to sell its old premises. Agents were appointed to assist with the sale. As at 1st January 2021, the old premises had a carrying amount of 8.4 million Ghana cedis. The old premises had cost 10 million Ghana cedis and were being depreciated over their expected useful life of 50 years. The agents advised the directors that the market value of the old premises at 1st April 2021 was 7 million Ghana cedis. And a commission of 1% was payable on sale. No entries have yet been made in respect of the old premises for the year ended 31st December 2021, but the sale was finalized on 1st January 2022 for net proceeds of 6.8 million Ghana cedis required. Show how the property should be dealt with in the financial statements of Nkonya for the year ended 31st December 2021.
Okay, thank you. Thank you. When was the decision made? When was the decision made to classify the asset as held for sale?
1st April
1st April
2021.
Okay. So what we have to do is that we have to find the carrying value as that date and also the net realizable value to compare whether there is an impairment or not, isn't it?
Yes.
Okay. So let's determine the carrying value. Can we determine the carrying value? So you can see that at first what?
January.
At 1st January, they have given you 8.4 million as the carrying value, isn't it? Okay.
Yes.
They have also given you the cost of what? The assets and also the what? The useful life, isn't it? All right.
Yes.
So let's determine the carrying value as at that date. You have so many ways of doing that. And is it question 5 or 4?
4.
Okay. So we are going to do this on April 1. On April 1, 2021. Okay. So we need to determine the carrying value, which is determined as a cost minus what? Accumulated what? Depreciation. Okay. Okay. Carrying value can be calculated as what? Can I say that it can be calculated as 8.4 minus depreciation for 10 over 50 times
50.
3 over 12. Do you agree to that?
12. Yes.
Do you agree to that the depreciation for this year will be 3 months? 10 over 50 times 3 over 12. Okay. Then if you take it from
Yes.
the carrying value at the beginning, that will give you your carrying value. Your carrying value at what? At 1st April. Or another way of doing this is that let's find this one before we move on to the other one. What are we getting there? I'm getting 0.05 as the depreciation. Confirm. 0.05 as the depreciation. Can you confirm that?
Yes, that is correct.
Okay. So the carrying value is 8.35. Okay. Let's look at alternative way of calculating alternative to the calculation of the carrying value. Let's look at alternatives to the calculation of the carrying value. Okay, so let's look at alternatives. Okay, let's look at alternatives. Okay, this can also be calculated like this. Look at this. This can also be calculated as, the carrying value can also be calculated as 10 million into bracket 1.6 plus, do you know why I'm getting the 1.6 from? Do you know where I'm getting
No,
the
sir.
1.6 from? The cost of the asset is what? Is 10 million, isn't it? The carrying value at the start of the year is 8.4. It means that the asset has already been depreciated for what? For some number of years, and the accumulated depreciation up to the beginning of the year is 1.6. The cost is 10. Carrying value is 8.4. The difference is the depreciation charge up to the date of the 8.4, which is the beginning of the year. Then we now find our depreciation for this particular year, which will be 10 over 50 times 3 over 12. So if you do it like that, you'll be getting the same value. All right. So we have the carrying value is equal to 10 minus into bracket 1.6 plus 0.05. Okay. Carrying value will be equal to 10 minus okay, minus that will be 1 point, would that be 1.65? And this will give us 8.35. Are we okay? All right. Okay. That is also another way. There's another way that you can also find it. There's another way that you can also get it, but you just have to take the one that you are comfortable with. Okay, the one that you are comfortable with, you can also pick it. Another one is you can also find the remaining useful life of the assets. How do you find the remaining useful life of the assets? The depreciation now, the accumulated depreciation should be calculated as the annual depreciation times the number of what? Years that we are calculated depreciation. So the depreciation is 1.6. We have the annual depreciation to be 0.5. So multiply by the number of years. So for you to find the number of years that they have depreciated the assets so far, it should be 1.6 divided by 0.05. Do that and see how many years that you are going to see. No, annual depreciation should not be 0.05. It should be 0.5. Okay, it should be 0.5. So annual depreciation, let's get the annual depreciation, 10 over 50. 10 over 50 is 0.2. Yes, 0.2 rather. So the annual depreciation is supposed to be 0.2. This is 3 months. So 0.2. Okay. So how many years are you getting? 1.6 divided by 0.2. I'm getting 8 years. Okay. So it means that the remaining useful life is supposed to be 42 years, isn't it? Okay. That 42 years should start from the beginning of the year. But we have already used what? We have already used 3 months of it. So that will be the carrying value will now be calculated as 41 times 0.2 plus 9 over 12 times 0.2. Why am I saying 9 over 12? We have already used what? We have already used 3 months of the what? The full year. So that will be calculated like this. So you can also calculate the carrying value like this. It means that the remaining carrying value will be used for 41 years and 9 months. And every year we are using 0.2. So what will be the total amount? You'll be getting the 8.35 for the same value. You can try it and see 41 times 0.2. That will give you 8.2. Then you find your 9 over 12 times 0.2. You add it to your 8.2, you'll be getting 8.35. So anyhow you want to get it, the only thing is just get a carrying value. That is the most important thing. So our carrying value is 8.35 at the date of the classification. So let's get a carrying value. Let's now calculate our net realizable value. Our net realizable value is the fair value less cost to sell. So what is the question telling us? What is the question telling us? Okay. The agents advise the directors that the market value of the old premises at 1st April 2021 was what? 7 million. And a commission of what? 1% was payable on sale. So it means that the market value, the actual value that you are going to sell it is what? Is 7 million. But if you sell it, if I get a buyer for you are going to pay me 1%. It means that the actual money that you are receiving is what? 99 what percent. Am I correct? You are going to sell something for 10 cedis and you are going to give me 2% of that. It means that you're only taking what? 98% of it. All right. So you can calculate the net realizable value as 99% of the amount, or so the net realizable value, the net realizable value can be calculated in so many ways. It can be the 0.99 times the 7 million, which will give us how much? I'm getting 6.93.
Yes.
Okay. You can also calculate this like this. Okay. You have your 7 million, which is the fair value less the cost to sell. So the cost to sell will be the commission times 7. Okay. That will give you 7 million minus what? 0.07. And that will give you 6.93. All right. That will give you 6.93. So let's now come here. Our carrying value is 8.35 million, and our recoverable amount, which is the same as the net realizable value, is 6.93. Is there going to be any impairment? Our recoverable amount is 6.93 and our carrying value is 8.95. It means that the carrying value is higher than the what? The recoverable amount or the net realizable value, which will give us what? An impairment. So let's calculate the impairment on this particular asset. The impairment will be 8.35 minus 6.93. What will be the impairment loss?
1.42.
1.42. Okay, 1.42. This will go to profit or loss accounts. All right. So let's now see what is happening now. Let's now see what is happening. Okay. All right. No entries have yet been made in respect of the old premises for the year ended this and this. So what will happen? We did recognize the what? The 8.35 from what? The PPE. Then we now classify the asset at head for sale at the 6.93 under current asset. But they are saying something over here. Okay. The no entries have yet been made in respect of the old premises for the year ended 31 December 2021. But the sale was finalized or finalized. It depends on the teacher who taught you. Okay. Depends on the teacher who taught you. Some of them will say finalized, some will say finalized. Anyhow, it's a how. Okay. On 10th January 2022 for net proceeds of 6.8 million. For net proceeds of 6.8 million. Does it mean they have already taken their commission from it? Does it mean that they have already taken their commission from?
Yes, sir.
Yes,
Yes,
because
sir.
they are saying that net proceeds. for the net proceeds of it means that commission has already been what charged against this one. But if they should say that the net proceeds, the asset has been sold at a market value or at a value of 6.8, then we assume that they are here to pay what? The commission. So the commission will still be charged on the 1%. The commission will still be charged on the 1%. Or if the people want to do it very well, okay, payable on sale. Okay, so the commission will be charged on the 6.8. If this should be the actual selling price, it means that the commission will be 1% on the sale. But some people, they can charge you a fixed commission that since it's 7%, we are going to charge a commission on the 7%. But this one, if they say that the asset was sold at a market value of 6.8, then it means that the commission is what is inclusive. Then we have to subtract it. But the question is saying that it has been sold for net proceeds. Net proceeds. It means that all selling costs has been taken into what? Into account, or have been taken out of what? The actual value. So we have sold the what? The assets for 6.8. The question now is, what is the value of the asset in our books? At what value are we going to classify the assets? Will it be the 6.93 or the 8.5? 8.35. The asset will be classified at which value?
6.93.
Okay, 6.93. Okay, but the asset was sold at what? 6.8, isn't it?
Yes.
All right. Although that is event after reporting date, can we see that that is an event after reporting date?
Yes.
The reporting date is 31 December 2021, but they have sold the asset on what? 10th January 2022. That is a report
2022.
after, that is event after reporting date. But you now have to ask yourself, is this an adjusting event or a non-adjusting event? If the asset, you have the asset at 6.93, maybe within 10 days, you have sold the asset at 6.8. Can we say that the actual value of the asset at the reporting day should have been 6.8? Can we say that? The value of the asset was 6.93 at 31 December 2021. 10 days after, you have sold the asset at 6.8. Can we say that the actual value of the asset at the reporting day should have been 6.8? Because
No, please.
okay. Someone is saying no, please. All right, no, please. Okay, no, please. All right. No, please. Okay, we are going to suggest your no, please to justify your inclusion. Okay, but we have 6.93 at the reporting date. Within 10 days, we are now selling the asset at what? 6.8. And I'm asking that, can we reasonably say that the value of the asset at the reporting day should have been 6.8?
Yeah.
Someone is saying that no, please. Someone has to say yes. It's either no or yes. Okay. You see the time that the asset was sold. Still, the financial statements were not what? Authorized for issue. Financial statements are still with management. Management has to sign it. But within that period, we are selling the asset at 6.8. This is enough justification that the value of the asset, the actual value of the asset, was 6.8, not 6.93. The financial statements were not yet authorized for issue. You see, we say event after reporting. These are those events that normally happens between the reporting date or after the reporting date, but those events that are happening between the reporting date, that is the 31st December, after that date, and the day that the financial statement will be authorized for issue. So those events that will be happening there between those periods. So from 1st January to maybe 31st March, that is the time that we can authorize the financial statements. We can publish it on our website. So between that period, those events that are happening within those periods, after reporting date, but before the financial statement we are authorized for issue, those events happening that period are what we call the event after the reporting date. So from 31 December, from 31 December to the time that we are going to authorize the financial statement for issue, or maybe from 1st January, that is after the reporting date, but before the financial statement were authorized for issue. They can't authorize the financial statement at 30th or at 10th June 2022. No, it will take like maybe 3 months. They have to deliberate on certain issues. Audit has to be done before they can authorize the financial statement for publication. So this should tell you that the net realizable value of the asset at the reporting date is just the same as the value that they have sold the assets immediately after the reporting date. So this is an adjusting event. This is an adjusting event. This is telling you that you have what? Overstated the value of the asset. So what you have to do is that you have to what? Carry out an impairment test on the asset again. So you compare this and this, then there will be additional impairments. Okay, there will be additional impairment, which will be 6.93 minus 6.8. What are we going to be getting? Would that be 0.13? Will it be 0.13 or?
Yes, please.
Okay. So that is this. We are going to be having additional impairment of 0.13. So what do you do? Let's come to our statement of profit or loss. In our statement of profit or loss, we are going to be having a depreciation of 3 months because the asset has been used for 3 months before it has been classified. So we look at depreciation for 3 months, that will be 0.05. Then we look at the impairment. Impairment will be 1.42 plus 0.13. Okay. But the question is, if this value should have been 7, if this value should have been 7, if they should sold it at 7, there will not be any issue because we classify the asset. We are just looking for an impairment. It should be at the lower of the carrying value or the net realizable value. So since this is 6.93, it is lower than this, so the asset will still be carried at the 6.93. Okay, at the 6.93. All right, that is for cost model. That is for cost model. All right. So let's come to the profit or loss. So what will be the total? Would this be 1.55? Would that be 1.55? Okay. Statement of financial position under the current assets. Under the current assets, you see non-current assets held for sale at 6.8 million. Okay. So that is basically about this question. That is basically about this question. Let's pick another one. Then we come back and do disposable group. Okay. We come back and do disposable group. Let's take the question 7. Question 7. Who is taking the 7 for us? Question 7.
Question 7. Ayejiase owns a building which it has used for many years as a factory. On 1st January 2021, the building had a carrying value of 18 million Ghana cedis. with an estimated useful economic life of 15 years. IAGRC uses the cost model under IAS 16 to account for buildings. On 1st July 2021, IAGRC commenced operations in a new building, and the old one was placed on the market as it was no longer being used. At 1st July 2021, the fair value of the building was determined as 16.5 million Ghana cedis, with associated selling cost of 0.5 million Ghana cedis, while the building's value in use was considered to be 15.4 million. It was seen as highly probable at that date that the building would sell for that price. By year-end 31st December 2021, the building remained sold. So IAGRC re-estimated the fair market price to 17 million Ghana cedis. However, the estimate of selling costs remained the same. The directors of IAGRC believed that at that date, it was highly probable the sale would occur within 12 months at the lower price.
Okay.
Can you please scroll up
Okay. Okay. You want to read the required.
the requirements?
Okay.
Required. Explain how the old building should be treated in the books of IAGRC for the year ended 31st December 2021.
Okay.
Thank you.
You're welcome. All right. Okay. So they are saying that the people, they have a building, they own a building that they have been using as a factory for so many years. On January 1, the carrying value of the building was 18 million with an estimated useful life of what? 15 years. So the people use the cost model under the IAS 16 to account for the building. On 1st July, so when are they making the decision to sell the what? To sell the building?
On
When are they
1st July 2021.
Okay, so we need to find the carrying value as at that date. How do we find the carrying value of the building as at that date? So July 1, 2021. So we are giving the carrying value of the asset at what? January, isn't it? At January. So what do? We have to find the carrying value at the date of the what? The decision, which is the 1st July 2021. Then we find the net realizable value too. Then we see how we can go about it. So how do we find the carrying value here? How do we find the carrying value? How do we find the carrying value? Can we say the carrying value is 18 minus what? The depreciation for 6 months? Can we say that?
Yeah.
Okay.
Yes, please.
That will be 18 minus what? 18 over 15 times 6 over 12. Is that correct? So the carrying value will give us 18 minus what? I'm getting 0.6. Is that correct? Is the depreciation 0.6?
Yes, sir.
Please.
Okay. So let's now come here. This one, they are saying that at 1st July 2021, the fair value of the building was estimated as what? 16.5 million with associated selling cost of what? 0.5 million. While the building's value in use was considered to be what? 15.4 million. When do we use value in use? When do we use value in use? Or what is value in use? When do we use value in use? When do we use value in use? Okay. When do we use value in use? We use value in use is purposely for a continual usage of the asset. So if you want to continue using the asset, what is the economic benefit that the asset is going to what? Derive to the entity as a result of what? The continual use over the period. That's why we do So value in use is for continual use. You either continue using the asset or you what? You sell it. But for the non-current asset held for sale, the purpose is that the company want to recover or want to realize the carrying value of the asset through sale. We are not going to continue using the asset. If you are going to continue using the asset, that will not be classified as held for sale in the first place. So it means that for held for sale, for IFRS 5, value in use is what? Is what? It's nothing. It's not needed for IFRS 5 because we want to realize the value of the asset through sale. So it's only the net realizable value that is important. So even if the value in use is higher than the net realizable value, don't pick the value in use because you're not going to continue using the asset. Value in use is for continual usage, the benefits that the asset is going to derive over its remaining useful life if the entity should continue using it. All right, so let's determine our net realizable value. We are given the fair value. Okay, we were given the fair value. So the net realizable value is the fair value less cost to sell. Less cost to sell. Okay, so we have the net realizable value to be 16.5 minus the associated cost of what? 0.5. And that will give us 16 million. All right. So our carrying value is 7.4 and our recoverable amount is 16 million. Is there any impairment? Is there any impairment there? Is there any impairment there?
Yes.
Okay, the impairment will be 17.4 minus 16. That will be 1.4 million. Is that correct?
Yes, please.
Okay, let's move on. There was a subsequent measurement somewhere. Let's see what the subsequent measurement will now be bringing. Okay, they are saying that the building remain unsold. So that we are saying the sale should be probable, like the sale should happen within what? Within a year. So at the end of this year, that is 6 months. That is 6 months. So we still have additional 6 months. So however, the building remain unsold. So IEDOC, we estimated the fair market value to be what? To be 17 million. To be 17 million. However, the estimated selling cost remain the same. The estimated selling cost remain the same. It means that the estimated selling cost will still be what? 0.5, isn't it? All right. So they can give you a percentage for the estimated cost. So if you want to know the estimated cost for this one, it will be the percentage multiplied by this. But they are telling you that remain what? The same. The estimated cost is still the same. If it is still the same, what is going to happen? If it's still the same, what is going to happen? It means that at the date of this one, we still have to find our net realizable value for the re-estimation. So we have our net realizable value to be the fair value, which is 17 minus the what? The cost to sell. So at that time, you are going to sell the asset and you are going to incur the same what? Selling cost. So this will now be brought down to what? 16.5. So the new realizable value now is what? 16.5. Okay. Is 16.5. Okay. You see, at this time, you can assume that the impairment has not happened at all. So if the impairment has not happened, what should have been the carrying value? The carrying value would have been the 17.4. Okay. So if the impairment has not happened, our carrying value should have been what? 17.4. It should have been 17.4. So if it is 17.4, what should have been the actual impairment? What should have been the actual impairment? Actual impairment should have been 17.4 minus 16.5, which is the new value of the assets now. What are you going to get? What should have been the actual impairment there? What should have been the actual impairment? 17.4 minus 16.5.
0.9.
Okay, it should have been 0.9. But what was the impairment that you recognized? It was 1.4, isn't it? It was 1.4, isn't it? So you have to go and recognize what? You have to go and reverse what? 0.5. Okay. you can also determine this like this. Okay, don't worry about that one. So what will happen is that the new net realizable value of the asset now, the new net realizable value of the assets of the building is 16.5. The question is, what value was the asset classified? It was classified as the lower, which is 16 million. So our old net realizable value was 16 million. So what is happening? You can see that there is a gain of what? 16.5 minus what? 16. And that will give us 0.5. So this gain, the question is this gain higher than the impairment recognized on the assets? No. Then we can recognize all the gain. We can recognize all the gain in the what? In the profit or loss. But situation where this particular gain is 2, we only recognize what? The impairment. That is a 1.5. That is a 1.4 rather. All right. So let's come to statement of profit or loss. So we are going to be having a depreciation. Depreciation for the first 6 months, that will be 0.6 million. Then we come to an impairment of the assets. That will be 1.4 minus 0.5. Okay, we are reversing 0.5. So that will be 0.9, which is something that I've gotten over here. Okay, if you come to the statement of financial position, you have your non-current asset held for sale, and it will be under current assets. Okay, it will be under current assets. So we have the current assets. Then we have the non-current asset held for sale and discontinued operation. And that will now be carried at the 16.5, the new value now, which is 16.5, which is 16.5. All right. That is it. Any question before we take some 5 minutes break and come back? Any question? We come back, we look at disposable group. Then we look at a change to the plan. All right.
Sir,
Yes, sir.
Linus,
Yes, sir.
please, if there is a gain, how do you recognize it in the profit and loss?
It will be an income.
Yes.
Okay.
Okay, it means that you are going to add it.
Yeah, you add it to your figures. It will be addition. But since we have a loss, we have an impairment loss. That's why I've written it against the previous impairment loss.
Just impairment loss. Very good.
So you should have 1.4 and the gain will be 0.5, but it will still reduce the 1.4 to 0.9.
Yes.
Okay. All right. Okay.
Because I'm asking because when you are presenting in the in the vertical format, that's the reason I'm asking that.
Okay.
You can credit the gain to, assuming you are doing the T account, you just credit the gain.
Yes, please. Even if you don't want to show the T, if you don't want to show the format, you can just write a double entry for the thing there. You can still debit profit or loss, with the depreciation. Okay, so you can say debit depreciation or profit or loss. That will be 0.6. Then you credit the value of the asset. We assume that we are using the net method. We are using the net method, not the accumulated depreciation. It's supposed to be credit accumulated depreciation. But since we are reducing it by the value of the asset, then it means that you just credit the assets. Okay. You just credit the asset 0.6. Okay. Then if you come to the impairment issue, you just say, okay, debit profit or loss with the 1.4 first. Okay. Then you also credit the carrying value of the asset, which will be 1.4. Okay. Then you still say that, okay, we should debit the value of the asset. We should debit the value of the asset with the reverser, which is 0.5. Then you credit the profit or loss, which is 0.5. If you can't show the T, you can just show the double entry and move on. Okay. You can just take the double entry and move on. Okay. But the T, always show the T. That will show that you're on top of issues. You are senior man. All right.
Okay, sir.
Okay. So that is it. If we don't have any question, let's go and come back in 5 minutes time. So this one is not anything that we have to waste time. Within 1 hour, we can finish. So let me put a 16.5 here. All right. So I'll see you in the next 5 minutes. Thank you.